In this video, you're going to learn about how we can tie together the basic LBO model that we created previously, along with the three-statement model for Apple that we created in the very beginning of this course, to create a more advanced LBO model. Now, the reason why we want to look at a more advanced LBO model is that the first time around, when we had our basic version here, this gave us the idea, the concept behind an LBO model, how you set it up, why PE firms actually buy and sell companies like this. And we got a good amount of the types of questions that you could receive in investment banking interviews with this type of model. But when you're actually working in investment banking or private equity, the model that you're going to use with a leverage buyout can often be significantly more complicated, and you have to take into account some details that we overlooked or simplified the first time around. One of those, as you can see right here, is that we only projected the income statement and cash flow statement. This time around, we'll be projecting all three statements. We'll also be looking at modifications to the balance sheet. Remember that in our merger model analysis, we combined the balance sheets of the buyer and seller and made some adjustments. With an LBO model, you have a similar process happening, except you don't really have a buyer. You just have the seller's balance sheet, but you're still going to make adjustments to it in order to come up with a post-transaction balance sheet for the seller. Another point that we overlooked in the basic LBO model is that under our debt assumptions, we just assumed that we had two types of debt, bank debt and high yield debt. This time around, by contrast, we're going to be looking at a lot more in terms of the different types of debt, and we'll be looking at three different types of bank debt and then two different types of high yield debt, all of which are commonly seen in LBO models. And we'll learn some of the trade-offs, how items like interest rates, principal repayments, and other options like that differ depending on the type of debt that you're using. Another item where we're going to look at a more complex version is with our debt schedules. Now, the first time around, we had a fairly simple debt schedule. Really, the only tricky part here was with the optional repayment formula, which gets a bit difficult to explain, but that was really the only tricky part. This time around, though, since we're going to be dealing with 4 or 5 different tranches of debt, we're going to have to look at this in a lot more detail, and we're going to have to create a schedule that includes some more complex formulas to support everything that we're going to do in this version of the LBO. So those are some of the more advanced features we're going to look at. Now, to support this, what do we have to do to our existing model? Well, at the top, we still have transaction assumptions, which is completely blank for now, but that is what would go in this area here at the top, transaction assumptions. And then under that, we're still going to have debt assumptions, and then other assumptions, sources and uses, similar items at the top. We still have our operating assumptions. We're still going to assume a minimum cash balance here. We have this initial cash balance listed, but we're not really going to be using that for this version. We just have this initial cash balance listed for our own reference. Now, under the operating assumptions, so for these items on the income statement, balance sheet, and cash flow statement, these are actually being pulled in directly from over here on our three-statement model where we made similar assumptions here at the top. So these are actually being pulled in directly from there. So we're going to reuse the same set of assumptions. Now you also see this column in the middle for transaction adjustments with debit, credit, and then FY 2009. So one difference with a more advanced LBO model is that rather than just assuming, as we did with our merger model, for example, that we combine the balance sheets and we have these new items getting created, we like to actually create pre-transaction and post-transaction versions of the financial statements. Now you don't need to do this for every single one, but we like to look at it at the very minimum for a balance sheet. So we like to see immediately at the moment of the transaction, what does the balance sheet look like? And then immediately after it, what does the balance sheet look like? And so that's what this transaction adjustments column, these three columns here, are for. Moving down to the income statement, you can see that I've already projected much of this. And again, this is being pulled directly from our three-statement model for the most part. So there isn't too much here that's different. I'm not going to waste time with projecting this all over again in these videos because you already know how to do that. We've been through it multiple times before. The key additions here are some of the acquisition effects that we'll look at. So we have a new depreciation line item and several new amortization line items. So we'll go into each of those and explain why we need to take into account those items. But that's really the main addition to the income statement here. Now in the balance sheet, this one is pretty similar to what we saw in the three-statement model. Not much is different on the asset side. There's only one new item, which is capitalized financing fees. And again, when we get into the transaction assumptions and the balance sheet adjustments, we'll get into that and explain why we need to create this new item. On the liabilities and shareholders' equity side, we have several new items. Revolver, and then we have 4 new types of debt here. We have a deferred tax liability, and then under shareholders' equity, we have sponsor common equity. So the types of debt here, namely the revolver, and then the 4 tranches you see under long-term liabilities, these are just different types of debt that we'll be using in the LBO model that we need to include on our balance sheet to make our 3-statement model work. The deferred tax liability gets created here for the same reason that it does in the merger model. And then under shareholders' equity, sponsor common equity just represents the ownership of the PE firm following the transaction immediately afterward. So this essentially takes the place of these other items that you normally see under shareholders' equity here. And so we're going to be essentially wiping out all these other items and simply replacing them with however much the private equity firm pays for the company under sponsor common equity. Now in the cash flow statement, this again is very similar. We have some new items up here: depreciation, amortization, accrual of paid in kind note, PIK note, and these will take some explanation, so I'm not going to go into them now, but these are really the main addition to the cash flow statement. We see that then we have capital expenditures, we have all of our changes in operating assets and liabilities, and then we get down to cash flow available for debt repayment. We see how much we're repaying for each of the different tranches of debt, and then we have net change in cash at the bottom. In this cash flow statement, we are still skipping over, if you go back to the 3-statement model, we are still skipping over the cash flow from investing other than CapEx and the cash flow from financing sections. And that's because these are 0 all the way across. So there's really no point in including these. They're all 0. That's what our assumptions say. The only one that's worth including here is capital expenditures. So that's how our cash flow statement is different. Other than that, below this we get into debt schedules and then returns calculations and then sensitivity tables. But overall, the model here is not dramatically different from what we saw in the original 3-statement model. Most of the additions have to do with these different tranches of debt, as well as some of the acquisition effects that are similar in some ways to what we saw in the merger model. So that's really the overview of how this model is different from what we've seen previously. Coming up next, we'll be getting into the transaction assumptions, and we'll be making the necessary assumptions and coming up with the numbers that we need to begin creating our more advanced LBO model.